Hi, it's Lee, and welcome to the Tech Economist. I know the economy is concerning right now. It feels very unpredictable. The market has already dropped so much more than we expected, and Tesla's stock price even more again. But is all this doom and gloom making us overly negative, so much so that we're ignoring the deal of a lifetime? People say these are the times millionaires are made, when you find the confidence to still buy. The stock market has inverse supply and demand. It's much easier to buy when the prices are higher, and harder to buy when they're lower. Although I suspect most of you are in the same boat as me, and spent everything you could already on the way down, not thinking it was likely the price would dip below $200, hence why the stock market is simply so unpredictable through the lows and the highs too. The demand is perhaps there, but investors have exhausted their resources in order to buy. In the past, when Tesla drops this low, I've sold shares and leveraged up with options. It was much easier then. We had internal company issues as to why the stock had dropped, combined with FUD and market manipulation, all of which were clearly temporary and would mean the stock price would recover once we navigated past those issues. And that's completely right. And I have it as proof. On the 2 occasions Tesla dipped so low, I did that, and I ended up making $500,000 in under 6 months as a result. Or at least on paper, at the peak. I ended trading out some of it with $300,000 profit still, of which I have since reinvested quite a bit of that, which is now at an obvious loss, and kept the remainder as a buffer for just in case, although it has been tempting to use. But since these new trades, nothing's really changed. They're still invested into what the company will be like in 2 years' time, and in my opinion, all that is required is Tesla to hit high volume production with their 4680 sales, and I'll still make a good profit, despite what we've faced. And we were told Tesla would hit this rate this year even, by Elon and Drew, and although that looks highly unlikely that they will hit a run rate this year now, I still have 2 more years. 100 gigawatt hours of cell production is massive. It's not far off twice what Giga Shanghai is doing in production already, yet these cells carry 2 to 3 times as much gross profit per kilowatt hour, and probably about 4 times as much operating profit. This is a big deal. Anyway, this isn't meant to be another video saying it's all about the 4680 cells. Most of you know the impact too. We're trying to assess if Tesla is a bargain right now. So you need to assign some sort of valuation to the company in your head, which is most likely some sort of PE ratio. What PE ratio should Tesla have around the current performance? For example, I would guess that Q4 is going to produce a net profit of around $5 billion, excluding any FSD deferred revenue that gets released. Sure, there are authoritative people suggesting just $4 billion, but I think we will find that once again, these same people will miss the earnings, just like they have almost every other quarter. Yet, for some reason, they still carry this authority. Just because they're some fund manager or even a billionaire, and people keep listening to them. And they like to stay conservative and not believe in the Tesla magic because it's not cool. But time after time, we see this Tesla magic. It's just not always where we expect. Like a lot of investors, expected FSD to be ready by now, and the stock to have jumped 10 times as a result. But instead, Tesla made a super popular, really profitable Model Y, and the stock jumped 20 times. Anyway, $5 billion in earnings for Q4 is $20 billion annualized. So what PE ratio should Tesla have even in this economy? At a run rate of around 2 million vehicles a year, with likely a chance of tripling, yes, tripling total earnings for 2023 compared to the current trailing 12 months, as long as there are no lockdowns. It's all totally subjective, and there are 2 ways to price it. One would be what you think is a good price for your investment for yourself, and the other is to try and judge what the market would place on it. The former is for you to determine at what return you expect and make your own judgment. Then, as a long-term investor, you expect that the market will eventually catch up to what you see. The other is more for the short term, as the market is fickle and you don't know what it will decide at the time. Right now, I still want to see some more progress with 4680 sales first. I want to see them get to an annual capacity of 20 gigawatt hours, either this quarter or next, to really lock in more confidence. Then I'm probably at around a PE ratio of 60, implying a valuation of $1.2 billion, or a stock price around $400. But that's my own valuation in this economy. However, the market doesn't understand the importance of 4680 sales. They don't realize how much potential and profit they bring. But also, they don't realize how much of the future the company depends on them and is sacrificing the stock price way more over Twitter than 4680 delays. Therefore, I would place a PE ratio of around 35 to 40 for the market, or based on the Q4 earnings, a valuation of about 7 to 800 billion, perhaps 20 to 30% higher than we're trading today, a stock price of around $220 to perhaps $240. If the economy is about where it is today, then, and Tesla hit this $5 billion in earnings for Q4, and Elon hasn't sold any more stock, then yes, I think it's possible to see Tesla trading above $220 again, which, let's face it, isn't still great, but a lot more tolerable than we've seen lately. This does, however, also imply that Twitter is not taking Tesla down anymore, and that Elon is excited about Tesla again and has stopped selling the stock. This was just an additional factor hurting the stock price. That would have been hard to foresee as an investor. You never know what Elon might do next. However, in the long run, he seems very confident about Tesla and the fact we will all get a good return, as long as you ride it out with him. I remember the painful crash in 2019, my first experience when Tesla had dropped more than half from its high. There were investors complaining on Twitter to Elon about how they'd lost their life savings or similar sentiments, all very upset. And Elon just said, very cavalier, something like, Tesla will be all right. Elon knows better than us. He knows the real value of 4680s or FSD, along with the actual chances of them becoming a possibility. In fact, I almost think at times that Elon wants you to have faith in him and trust and believe him, no matter what he does, and you will be rewarded for your loyalty. However, I do not advise this as an investment strategy. I'm looking at the numbers and battery progress. Although I have no more funds to invest in it, I do it just to make sure my investment is okay and to make me cope with how many millions I may be down. But if I'm completely honest, I do wonder what it would actually take for me to ever consider selling my shares. But that's the thing, I did all this due diligence beforehand to make sure this was a really solid company and why I felt so confident investing so much in the first place. We had these massive buffers like waiting lists and margins, except now, in some markets, we've exhausted the waiting lists and even eating into some of the margin by lowering prices, just a fraction. And people are freaking out because Tesla are using the buffer they had to make the investment safer. This is what it was for, to make sure Tesla don't have to worry about the bad times because they can get through them with this buffer. And they'll work. And it's only even a small price drop in a market that isn't as big for Tesla as people make out. China is still a developing nation. Despite so many people there and so many cars sold there, the amount of people who can actually afford a Tesla is likely not as big as people think. For example, China's only about 20% of BMW's market, and they are running at market saturation. Tesla still aren't finished ramping, and they're still selling every car they make. We're about 1/2 the way through Model Y production run rates. There are plenty more people to buy Teslas. And China is the export hub for Europe, Thailand, Korea, Japan, Australia, New Zealand, Singapore, Malaysia, Hong Kong, and many more markets, maybe even South America. In fact, Australia are just passing a new EV subsidy, which takes the price off a new EV as much as about 9,000 Australian dollars. There are almost 1 million new cars a year sold in Australia, and I would bet that a lot of people who buy Teslas are not even new car buyers. In fact, everyone I know in New Zealand and Australia who bought a Tesla, it was their first new car purchase. And with higher fuel prices in these markets, it makes the demand that much more elastic. So when you get these sorts of subsidies, it's huge. In other words, I think Australia alone could probably buy about 200,000 new Teslas a year, or about 20% of China's production. Tesla just need to work on logistics. Anyway, like I said, valuing Tesla is subjective, but my estimates have me at around triple earnings from the current trailing 12 months, which is currently giving a PE ratio of 56. And if you divide that by 3, it becomes 19. I.e., if Tesla triple earnings, then in January 2024, when we get the earnings report, at this current stock price, Tesla would have a PE ratio of 19. And that's based on deliveries of around 2.3 million, which in my opinion isn't very good, based on a slow 4680 ramp and excluding any more LFP growth. Yeah, do you think Tesla are going to suddenly stop purchasing the exponentially growing LFP supply? That's a thought I'll leave you on. Thanks for listening. please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.